Welcome to the Three Edge Week in Review for the week of June 20th. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here today once again is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing whether there is a recession looming for the U.S. economy. We'll dive into the definition of recession, as well as the probability and the potential timing of a recession here in the U.S. We'll also discuss how investors could think about protecting their investment portfolios from a potential recession. First, a brief look at market activity. During the past Juneteenth holiday shortened week, both the stock market and the bond market seemed to at least settle down a bit, following very steep declines in the prior week. Investors seem to be trying to understand if the Fed can rein in inflation without tipping the economy into recession. And this week, investors were super focused on Fed Chair Powell as he provided his testimony to Congress. And we were looking to see if he gave any indication that perhaps the Fed would back off from raising interest rates at some point if they were to see signs of the economy weakening by more than they can stomach. Here at Three Edge, as we approach the 4th of July holiday, we remain cautious towards U.S. equities, which by our measures, we still consider to be overvalued, even after the S&P declined into bear market territory recently. Of course, we also realize there could be potential for snapback rally in equities at any time as well. So, Steve, it appears that there are two things that are on investors' mind currently: inflation and rising prices for basically everything, and in particular, the potential impact on consumers of record high gas prices. And investors are also worried about the potential for an economic recession here in the U.S. And interestingly, the future path of both inflation and the U.S. economy will, in large measure, depend on actions by the Fed as they undertake the difficult job of reining in inflation without slowing the economy too much. And if you don't mind, I'd like to point out one quote from Randall Forsyth over at Barron's that I quite like, that seems appropriate for the current environment. Randall Forsyth said, "It is the Fed's world, and we are all just living in it." And I think that's relatively apropos for where we are here. But since we've covered the topic of inflation recently, today we'll take a look at the potential for a recession here in the U.S. And let's just begin with the simple, what is a working definition of a recession?
Well, Fritz, most of the time, the economy is growing. That's the norm. But from time to time, we slip into a recession, which is simply the economy growing so slowly that it actually kicks into reverse. Now, there's a rule of thumb that many people use, which says if the measure of GDP, which is just the growth rate of the economy, is negative for 2 consecutive calendar quarters, then a recession is declared. And that's a rule of thumb. There's a more official definition, though. There's a nonprofit organization called the National Bureau of Economic Research. And their sole purpose is to meet as a group and to officially declare whether there is a recession or not, when it started and when it ended. And they take all the data they need to make that decision. And often it could be several months before they actually declare a recession, and then they go back in time and say, well, the recession started, a few months before, now that we know this data, and then they declare when it ended.
Excellent. So this week, as I said earlier, we had Fed Chair Powell in front of Congress, and he said that engineering a soft landing where inflation comes back under control without causing growth to fall, in his own words, was going to be very challenging. So why don't we discuss what are the prospects for a potential recession to occur here in the U.S. at some point? And if there is a recession looming, when might we expect it to occur, or are we already in one?
Well, it's very appropriate to be talking about a recession because when the Fed realizes that inflation is getting out of control, they often have to react so strongly because they've been late to the game that they tighten things so much that they do cause a recession. So it's very appropriate to be talking about this. Now, one of the best leading indicators of a recession is the slope of the yield curve. And this has been a fantastic leading indicator going back decades in time. There's a conventional view about how to measure the slope of the yield curve and what that tells you. And then at 3Edge, using our research, we found that it was very important to make certain adjustments to that conventional view to get a more accurate leading indicator. So we're going to share both with you. So first, the conventional view is that the yield curve is the difference between the 10-year Treasury yield and the 2-year Treasury yield. It's quite straightforward. And you can see on the accompanying graph that that is a very flat line. The 2-year yield has risen markedly over the last few weeks and months, and as has the 10-year yield, but not as fast. And now that it's a very flat curve. And that is a dire warning sign that an inflation is upon us or is imminent. And you'll typically see a normally sloped yield curve in normal times that is, more steep. And you'll see the 10-year higher than the 2-year. And then when that flattens, that's a big warning sign. And when it inverts, that's typically when you're in a recession. So that's one reason why economists are very alarmed. Some of them are saying we're already in a recession. Others are saying it's imminent. However, when you look around the economy, it doesn't feel like a recession so much. You still have a very, very low unemployment rate. Restaurants are bustling. Airports are packed.
Right.
So now let's turn to our measure of the yield curve slope. And what we recognize are some important adjustments that need to be made. And our research confirms that this leads to a more accurate leading indicator. Number one, it's often said that monetary policy operates with a large and variable lag. And what that means in English is that when the Federal Reserve Board decides it's time to tighten monetary policy, to slow things down, or when they decide to loosen, it takes a while before their actions ripple through the economy and make a difference.
Right.
So they do something. Sometimes the market reacts more quickly, but the actual economy takes time before it works through, ripples through the system. And we've had a situation where for years now, or ever since the pandemic, massive stimulus, and only recently has that stimulus stopped. But with that lag, the economy is still feeling the benefits of all that stimulus. And that's one reason why recession might not be as imminent as many think. Second is we found that rather than comparing the 2-year Treasury yield to the 10-year, it's more accurate to look at the comparison between the 3-month Treasury and the 10-year. And then third, we found it's critical to make an adjustment on the 3-month Treasury bill yield to adjust it for the change in the size of the balance sheet of the Fed. And if you think about it, when the pandemic hit, the Fed lowered interest rates to 0, but that wasn't all the stimulus they added. On top of that, they expanded the balance sheet by trillions of dollars. And our algorithms show that that was the equivalent of dropping the 3-month interest rate from 0 to minus 1.5%, roughly. So that's a huge extra stimulus that people don't get when they just look at interest rates. So now we'll show an overlay on our graph of the more conventional view of the yield curve, showing our view, and you'll see it's a lot steeper. And that's why we believe the recession hasn't happened quite as quickly as some economists expected it to. However, you'll note the arrow pointing upward, and that's an indication that we already know with this lag that interest rates recently have gone up sharply on the short end. We already know the Fed is committed to reducing the size of the balance sheet. So that short end is going to go up quite quickly. And so the prospect of the yield curve, even the way we measure it, getting flat or inverted is very high. So we do think the recession risk is high, but we think that it might not come quite as quickly as some people think.
All right, excellent. So my final question is, as usual, based on what we've discussed here today about the possibility of recession in the U.S. economy. So how could investors think about protecting their portfolios for an impending recession?
So, some people will advocate that we're already in a recession or that it's imminent. And so it's a guarantee. Some people will say we're going to miss the recession. There are those that are arguing we're not going to have a recession. The real answer is neither of those. The real answer is that whether or not we go into a deep recession depends on decisions that the Fed still has to make that they haven't made yet, and they're not sure what they're going to do. They don't know how many more times will they hike rates. They don't know if they'll abandon their quantitative tightening, meaning that they'll start not reducing the balance sheet so quickly. So all that's still to be determined. Given that, though, the risk is high that we could be entering recession sometime in the next 12 months or so. And with that in mind, we think it's very important to stay defensive. Also, even in the absence of recession, we believe that the equity markets, US in particular, became so overvalued that even with the large decline we've had since the beginning of the year, the market is still overvalued. Now, let me turn to the seasons of the market chart. We've seen this before, and we just continue to find this always as a great frame of reference. So for a long time now, we've been in an overheated economy. And if you translate that to a season, it would be summer. It's too hot. And we've had unemployment near record lows. We've had inflation at 40-year highs. And the Fed realized that they're behind the curve. They let the inflation cat out of the bag, so to speak. And now they're tightening. And what happens after summer but fall? And that's when you get into a credit contraction. So this is a cycle the economy's gone through many times. And if the Fed carries out and does what it says, then interest rates will have to go up substantially more than where they are now. The balance sheet will have to shrink substantially more. And we will get that inverted yield curve, and we will go into a credit contraction, a recession. And in that case, equities will continue to do badly. It's still too early for the bond market. Real assets, which have done extremely well over the last several months, will even could start to falter with lessening demand from the economic side of things. And the best, safest asset under that condition in the season of fall would be cash and cash equivalents, and maybe Treasury inflation protected securities, which gives you a rate of return closer to the inflation rate. So we are planning, and we would advocate to maintain a defensive posture, keep your equity allocations lower than normal, keep your long-term bond allocations lower than normal, at least for now. Consider reducing real assets if they're quite high right now, and don't be afraid to hunker down. Now, there'll be temptations because every bear market, no matter how severe, has, as you pointed out, Fritz, these bear market rallies, which make people think it's over, and it just lures you to jump back in, and often is premature. And as I've said in the past, one of the worst bear markets in history was the tech stock bubble bursting. The NASDAQ 100 index fell from March of 2020 to September of 2022, fell 83%. And during that time, there were 16 bear market rallies, the least of which was up 10%, and could have tempted you to jump in.
Right.
So we say it's better to be safe than sorry, stay defensive, and let's see how far the Fed goes.
Excellent. Great. Well, thank you very much for that insight. And before we go, I have a programming note. And as next weekend is the 4th of July, long holiday weekend, we won't be producing our video for next Saturday. And in addition, now that we're into the summer months during July and August, we will continue to produce the 3 Edge Weekend Review and the View from the Edge videos, however, on a less frequent basis. And that's primarily to allow the many people involved in creating these 3 Edge videos every week to be able to take some time off with their families and get some vacation time, because people do spend a lot of time both before and after we actually make these videos to produce them and get them sent out to all our clients. Now, of course, anything should occur in the global capital markets, which we feel would warrant creating a video or a written commentary to keep our clients informed over the course of the summer, we will not hesitate to do that. Remember that all our videos are available on our 3 Edge YouTube channel. In addition, all our videos and written commentaries always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone at 3 Edge, thanks for listening.